This is the DarshanTalks podcast, regulatory guy, irregular podcast with host Darshan Kulkarni. You can find the show on Twitter at DarshanTalks or the show's website at DarshanTalks.com.
Hey everyone, welcome to another episode of Darshan Talks. I'm your host, Darshan Kulkarni. As you may remember, I'm an attorney, I'm a pharmacist. I advise companies with FDA-regulated products. So if you work in or have an interest in an FDA-regulated company or its products, this is the podcast for you. Today's podcast, so we are talking to someone who is a big investor in the life sciences and in things that, in biotech, and works in general from an entrepreneurial perspective, works with entrepreneurs all the time. So if you are a C-suite executive or you are an individual looking at financing and you're going, what are these if I'm a startup company trying to figure out how to get financing, what are potential investors looking at? This is the conversation you want to tune into. If you like it, please leave a comment, please subscribe. What we should talk about is the person we're going to be talking to is a physician. He's an investor focused on ventures in biotech, digital health, and space commercialization. He provides expertise in strategy, in capital allocation, and market adoption. He also hosts a podcast and writes a newsletter called Looking Around the Corner, which celebrates the entrepreneurial spirit. So your guest today, ladies and gentlemen, Dr. Falgun Choksi. Welcome, Falgun.
Hey, thanks, Darshan. Thanks for having me.
Thanks for coming on. It's good to have you back. We already have people tuning in going, oh, this should be interesting.
I hope so.
So let's talk a little bit about some of the conversations that we couldn't have the last time you came on. So let's start from the basics. We're in the middle of COVID. We're talking about people going, you know what? I am struggling with this idea of high unemployment. We keep looking at unemployment numbers. Today's news was unemployment numbers were rising again. What is your take on, when you compare to unemployment, how is the actual investing going as a potential investor? Do you think that the market's bubbling? Is there activity? What's going on there?
Yeah, it's actually an interesting question. This question comes around every so often, every few days, somewhere in the media circuit. There seems to be some type of dissociation, at least in my opinion, between what is happening in the lives of let's say the average American, who may or may not have a job, who may or may not have financial difficulties or not, and then what we see on Wall Street, where there is definitely a lot of exuberance right now. The market is, for all intents and purposes, at significantly historically high levels. Both the Nasdaq, S&P 500, they keep touching new highs every few weeks, and it almost, if there was a third or fourth person looking onto us, it would almost be like, wait, are we talking about two different Americas or two different worlds, so to speak? And I think that's what it is. I think there is this significant sentiment in the market of this somewhat unrealistic optimism, as I like to call it. I'm an optimist at heart. I do try to look at the glass half full and hopefully try to fill it up all the way. But I do think that there is something that doesn't click with this. Look, I'm not going to complain too much. I've been lucky enough, like some other investors, to have done well with this market sort of being frothy and bubbling up. I don't know if it's a bubble or not. I think bubbles are always in hindsight. When people say, oh, they can forecast bubbles, there's always like, yeah, really? Can you really do that? It's one of those things, like it's a bubble after it pops, so to speak. I do think that a couple of things are sort of developing a handicap in the long term for us. One would be the fact that the Federal Reserve just keeps pumping money into the system. We are going to see the devaluation of the U.S. dollar as time goes on, and inflation will also contribute to that. And I think that's one of the arguments that you're seeing right now with this a significant increase in buying of cryptocurrencies, specifically Bitcoin. Over the last few weeks, we've seen an unbelievable amount of volume going into purchasing Bitcoin. I've been guilty of it too. I kind of I piled on the bandwagon a little bit, and it is, for some people, it's a hedging measure. They're trying to hedge against what's going to happen to the value of the dollar. So I have a feeling 2021 is going to be a more interesting version of 2020 in certain respects, and we're seeing that play out already. I think that investors, always be cautious, do your due diligence. It's very easy to get caught up in the hype. I've been guilty of that as well as a lot of other people. It's very easy to just look on social media and be like, oh, GameStop. Okay, let's pile on that, or let's pile on AMC, or let's pile on, the new SPAC that's coming out. But I think one of the things about financial literacy is understanding, how a company functions, how does a stock get valued, et cetera. And then you sort of have to realize, like, hey, what am I doing this for? Am I doing this for the long game, or am I just doing this to get a quick sort of hit? And I mean, I've never been a believer in get rich quick, because I don't think something like that exists. But I think there's a lot of sentiment like that out there.
So I'm going to disagree with you. I'm a huge proponent of get rich quick. Unfortunately, it's blown up in my face far too often. That's my big problem with it. I'm still.
I want to believe in it. It's not like I don't want that, but in my experience, it hasn't happened. So.
I'm one of those people who's like, wait, GameStop's going up, I'm going to buy it. I bought it at $340, and then I was like, wait a second, it just keeps dropping from here. So
my trade, I got lucky.
My own cautionary
my trade never went through. I got lucky because my trade never went through. It was that whole thing when they're locking out, and I was like, hey, whatever happened for a good reason, I guess. See, I fell for it too.
But here's my question. Let's sort of go back to the question that maybe I should focus the question a little bit more. In the angel investing community, so there are no stocks yet. People are still investing early on. Mm-hmm. Are people having conversations going, you know what, I want to buy a biotech company? I've had 2 or 3 people reach out to me, and within the last week, and that's a higher interest rate than I've seen in previous times. Are you having those conversations? Are more people going, you know what, I'm going to stay away from biotech and I'm going to go into something safer like Bitcoin, which is really weird to say.
Yeah, because it's technically not that safe, right? It is a pretty volatile currency. So, I mean, the way I look at it is that I compartmentalize private investments and public market investments, in a very concrete way, where private investments, they tend to be focused more towards accredited investors. There is some equity crowdfunding resources out there, and there are some changes that the SEC is making this March 2021, which will allow more of the average citizen, so to speak, the average person in the United States, to get in on these private deals, so to speak.
Yeah.
And the thing about angel investing is that I've angel invested in a few companies, and it's a very different paradigm, right? It's not the same thing as saying, okay, so and so stock, like Airbnb is going to IPO on the public markets. Okay, I'm going to buy a position, right? I mean, you have really no skin in that company, honestly. Right. Like you it's like any other company, honestly, that IPOs. There's going to be some hype around it. Hopefully, if you're able to read the S1 and if you're able to read some of the documentation, you get a little bit of better understanding of their financials and their future projections. But in the angel, you're so early in the game that really what you're doing is you're trying to get enough deals in your portfolio, very much like how a VC functions, to say, okay, I'm going to hope, 1 angel deal, 2 angel deals, they may or may not hit. You're not really de-risking anything, but you really kind of have to expand it out to be like, okay, I want to get like 8 or 9 or 10, and to be like, okay, if 8 of them flop, which statistically, there's a high likelihood for all these businesses to fail, right? They're very early stage. So if 8 or 9 out of 10 fail, but the 10th one hits, and then I have a liquidation event where I'm able to 10x what I put in, or I'm able to even do more, then it makes all the other deals sensible, right? So it's almost like you want to grow out a portfolio. Well, the problem is you need some capital for that, right? So you have to decide. Like the way I look at it is that I look at it as like, okay, what can I lose that I'm not going to lose sleep over? like that's usually my barometer, right? I love my sleep. I feel though that I think there's a lot of money out there right now. There's a lot of money floating around in the system looking for a way to grow. So what's happening is that you hear a lot about like, oh, this company got this much of a pre-seed round or a seed round, or they ended up getting a Series A eventually, whatnot. And I feel social media tends to amplify a lot of these, hey, I got this round or I got this deal. What social media does a horrible job of saying is, oh, well, how many of these actually failed, right? Like everybody wants to sound like a winner, but we know statistically that 95% of companies fail. So where are all those companies? So I look at it as like when I do angel deals, I look at it like, okay, do I believe in that founder? Do I believe that if they had to pivot, or they're able to do so? Do they have a team? But I also know that I'm probably sinking money into something that I'm probably going to lose. I'm going to lose money on. You know, I'm going to take a loss on it. But it's a different game. Like angel investing is a different game than the VC game, which is a different game than the public markets game, which is a different game than the crypto game. So you have to kind of decide as an investor, what game can you tolerate? And I will tell you, it takes trial and error. And again, none of this is financial advice, but this is my experience. You know?
So let's talk a little bit. You mentioned this, so I think it's interesting. Have you lost money on deals yet?
Yeah, I've lost money. I've taken losses, and this is why one of the nice things is like a piece of advice I got from a mentor was always make sure that when you're going in on an angel investment deal, that the company is incorporated as an LLC, because it becomes a pass-through entity. So therefore, you can go ahead and take the loss on it. So if you put in $25,000 and you lost it, and the company went bankrupt, you got the letter saying that okay, it's bankrupt, etc. You can take that as a loss on your own income taxes, right? Because you put money out, and that money's gone now. So it's I have lost money. I've made some money. I like the thrill of it, honestly. Like I like the thrill. I like to be able to help someone who I believe in to try to build something that will be of value to customers or other businesses. But it's not for everyone. I'll just tell you that it is not for everyone. It's probably not for most people. For most people, if they want to invest, stick to the public markets. There's a lot more insulation built into the public markets because it is public, and there's a lot of accounting practices that have to be adhered to, a lot of SEC rules. The private world, it's a little hit or miss depending on who you're dealing with.
So what lessons have you learned from your losses? I mean, I don't know what kind of companies you had, but as someone who's been a part of far too many companies that did not go the right direction, do you feel like what was missing was the right team more often than not, or is it just the technology was wrongly timed, or what have you seen as a common thread that people are missing?
I guess when I first started out a few years back, some of the things that I was not really good at was understanding what the dynamics between co-founders were. A lot of times companies with the best of intentions and even the best business model and whatnot, they tend to go downhill because the co-founders, can't get their act straight, they can't see eye to eye. And that's there was one company which was sort of like an e-commerce play that I invested in a few years back, and the co-founders, they had a falling out. So the problem was that there wasn't, like, I wasn't sophisticated enough to be like, okay, well, what exactly are you doing to remedy this? So it sort of spiraled, and at some point the company went downhill. And once the company started going downhill and you start burning through cash, and then your cash position just becomes nil, you're done. Yeah. It's like you have no oxygen left.
So that's so interesting. It's this idea of co-founders not working well. Most people think it's either the idea or the people individually. And you're saying, no, the interactions of the people are just as critical, if not more critical. Yeah. I guess my question for you is, did you try to fix it? Or should you try to fix it? Or is that you changing your role from a passive investor to an active investor? And that's not the world. That's not the world.
See, the thing in angel, it's funny because you really want to be at the table with the team early on, because you're sort of putting that first money that comes after like friends and family. They go to their friends and family and they get X amount or whatever it is. And then now they're coming to a person who's like, I'm not related to them. I have no skin in the game other than the fact that, okay, you have this idea, you have this team and whatnot. I mean, I would say that the co-founder issue is one of different issues that can occur. I've seen companies where the issue was that, their timing was bad. Like, they got into, they were trying to get sort of into a market which was not ready for the solution that they were offering. Sometimes it is just bad luck, timing, and then sometimes it is, they try to go head to head with a dominant player instead of trying to find a niche to kind of circumvent that a little bit, kind of like the disruption and innovation angle that Clayton Christensen used to talk about. And some of it's really just bad luck, honestly. Sometimes things just compound, and then all of a sudden you realize that, okay, this is probably not going to work out. Now I've become savvier to where I'm de-risking myself to where now I started investing in companies that already have some revenue. So now I kind of know, like, okay, they've already tested the market out. Basically there's someone out there willing to pay for what the hell they're selling, So now, I've sort of gone downstream in that ecosystem and be like, okay, if I'm going to put my money, if I'm going to de-risk it, then I would like to put it in something that there's already some revenue, which those deals are different than, hey, we have, we're like two people and we have this idea and we, it's kind of pie in the sky. We did a little bit of prototyping. So that's the thing about private deals is like they have their niches, and as an investor, sometimes you bounce around a little bit until you find out when your expertise and your niche lines up with what you're looking for.
So that's an interesting point, right? You talk about this idea that you could be a seed investor or an angel investor, and I guess just to identify for people, it's seed, angel, venture, and then PE companies. When you're talking seed, like you were, what do your numbers tend to be like? Like, at what point would you go, this is worth investing? Like, this is the amount of money I'm willing to put up.
Yeah. So, usually what ends up happening is like you'll get like, seed tends to, nowadays they say there's a pre-seed and then there's a seed and then there's a Series A, Series B, and all that kind of stuff. Yeah. I mean, your angel investing really goes into your sort of pre-seed, seed rounds. That's because the angel is the first really non-family friend that gets in there, right? I mean, what I look for now is that I say, okay, look, can you show me some recurring revenue? Show me what your month over month revenue is. Show me, do you have debt? Because at the end of the day, if a company goes under or if there's a liquidation event, debt always gets paid first. Before any equity is doled out, debt has to get paid out, and that's the system. So I don't like heavily leveraged companies, especially when they're starting out. I also see like, okay, what is their business model? How can they pivot if they needed to pivot? Like, let's say, they're not getting traction in a certain type of product or service that they're providing. Are they able to pivot to something else that's somewhat lucrative that people want? Are they making any intellectual property that can itself be monetized? So for example, I'm an investor in a company called DeliverStat, and DeliverStat is a independent pharmacy delivery company, right? Yeah. So the interesting thing is that they do that part of it, but they're also building out a proprietary SaaS model as well. So which is really nice that's like, that's like candy on top, so to speak, for an investor, because you're like, oh, so now you're splitting what your revenue streams are going to be. You'll get the stuff from your original business model, and then you can also license out your SaaS model as well. So it's not like, I don't try to go into the stuff that has no structure anymore. Like before, I would try to do that kind of on a romantic notion that, hey, I can be one of those first guys that help, and next thing you know, they become the next freaking Google or something. Right, and then I realized that's not realistic, especially in certain verticals.
Okay, so you've now reached a situation where you're going, but I guess what I was wondering is, on the when you were early on, when you had that romantic perspective, how much money were you willing to bet? And I'm obviously this is just talking to you, but is this at that point more of a $5,000, $10,000 range, or are you still considering valuations in the $50,000, $70,000 range?
Yeah, like I would put in positions that range between 10 and 25,000, depending on what it was,
for super early companies.
Yeah, for super early, because again, what you're trying to do is you're trying to get in at a very discounted rate, right. Early on. So you're trying to get in to say, like, listen, right now this company is worth 500,000, or maybe it's worth a million or whatever. So I'm getting kind of like the very discounted share price on there. And then as it grows out and then the valuations increase, I mean, really what I'd love to do is I don't really look for companies that I want to take I want to wait until they go to IPO. I would rather get companies that I can get to a Series A or Series B, and that's a liquidation event. All of a sudden the valuation shoots up. Okay, man, I'm out. Right. I'm gonna sell my, and that's how I can de-risk it, because then I can take that money and put it into something else.
Right. So, and then now you said you're working with companies that are further along. So what do
I try to work with companies that have now. Yeah. So I'm getting in later, as far as how much discount I'm getting on the, on my contribution, but I work, I like to see, okay, they've proven out their business model. Meaning someone is willing to pay money over and over again for their product or service. I like that, and I'm willing to give up a little bit of my discount, because now I'm de-risking, that investment. But I also, again, I never put in more than I'm willing to lose, and then not lose sleep over. So I don't write really big check sizes. I would rather write modest size checks for multiple different companies, because I just know statistically they're not all going to work.
Right. So you don't technically increase your investment. So you're not going to a $50,000 range anymore. You're still going, I'd rather have two companies, 25.
Yeah, I cap it just based on my comfort level, because I would rather have multiple in a portfolio and be like, okay, let's see which ones pan out, as opposed to, because the thing is like, I look at different asset classes too. So I say, okay, well, if I want to invest in real estate, this is what I'll do my real estate investments. If I'm going to do, sort of equity, startups and whatever, for early rounds, and this is how much I'll put in. And then the other thing is, like, I have my own interests for, startups ideas that I have. So therefore I'm like, well, I would like to invest in myself too. Absolutely. That's usually the best investment, honestly, is to invest in yourself, because that's really the only thing you can control the most is you.
So that raises the next question. We talked about the different things that can go wrong, and we talked about this idea that you can have the wrong people together, you could have the wrong timing, you could be competing against the wrong behemoth. But another question is, you could be in the wrong place. And we all know that if you really want to succeed in, say, technology, you should have been in Silicon Valley in the 1980s. And you probably had a better chance of success than if you were sitting in, Timbuktu in 1970. So my point is, you're from Atlanta, and you've recently moved to the Philadelphia area. Philadelphia likes to position itself as quote unquote Silicon Valley. My question for you is, from an outsider's perspective, does Philadelphia really have that name, or is it just Philly cheering itself on when it hasn't gained that traction yet? Like, we all know Boston is still super hot around healthcare. Does Philadelphia show up in those ranges? My first question. And my second question is, if it does or if it doesn't, what can it do better?
So I'm not. I don't know that much about the Philly investment community or the startup community to the point where I can give a very nuanced answer, but I can say from the perspective of, like, let's say an outsider, who recently moved to the area, about what is it that I would want to look for, like, in a hub, right?
Yeah.
So let's say like a biotech hub, life sciences hub, let's say. And I think what the interesting thing about Boston is what sets it apart is that it has this very amazing ecosystem where you have a very not a completely lockstep function between the academic institutions and then the startups and then the incubators, accelerators, and the actual investors around the community. But it is very tight. So you have the geographic proximity, right? You have a plurality of institutions. You have obviously MIT, you have Harvard, you have and even within Harvard, you have a lot of the different hospital systems like Beth Israel Deaconess, and then you have Mass General and whatnot. And then the ecosystem that comes out of there as far as their startup founders and people coming up and setting up shop is nice because it is supported by an investment community that is willing to seed those companies. So that's the thing, is that you have to have access to capital in all its different forms in order to grow a hub. And that, like, if the thought every time is like, okay, I want to start a company in Boston, but I gotta fly out to San Francisco and meet with the VCs there because only they're the ones who do these kind of companies. If that is the only way to do it, then that is kind of an Achilles heel. Now,
Right.
People still do that, right? People still fly out to San Francisco, to Silicon Valley and whatnot, and they say, okay, this is what my play is. Here's my pitch. Okay, we'll invest this much in your Series A or whatever. But the nice thing about Boston is that you have a lot of that infrastructure already built in. Atlanta, interestingly, it has come up a lot, but it hasn't come up as much in the healthcare vertical as it has in, let's say, the financial services vertical, stuff like that, or in fintech. And the reason why was because the capital was going towards those verticals as opposed to the healthcare vertical. Cambridge and Boston, it revolves around that biotech and health sciences and life sciences vertical. New York, so Philly, just from a perception standpoint, Philly, it has a lot of great institutions. You have the Penns, you have the Jeffersons, you have this ecosystem of very top-notch academic institutions. But the thing, at least my perception is that I don't see that tightness in the investment community there. Meaning, it's easy to get on a train and go to New York to find money than to stay in Philly. Now, there are a lot of investment firms in Philly, a lot of VCs, a lot of angels and whatnot, but the perception I get, and I hope someone can correct me if I'm wrong or whatnot, just because I'm more of an outsider right now, is it's just easier to go to New York because New York has a much more built out capital infrastructure, right? I mean, literally, it's a financial center of the world. So at the end of the day, I feel like maybe Philly's in New York's shadows a little bit, but the way I look at it is if Philly wants to really step up their game, there has to be a commitment also from the perspective of the government there. The mayor's office, the actual government policy infrastructure there to say, okay, how can we catalyze this? So the best example playing out right now in the entire nation is Miami. The mayor of Miami has single-handedly, his team and him have single-handedly catalyzed one of the most visible migrations of investment firms, or at least expansion from Silicon Valley to South Florida. And they're the only major city in the United States that actually has, they're going to start paying their employees in Bitcoin as an option. They're investing in cryptocurrencies. They actually have the white paper, for crypto. So, and I'm not saying this for people to invest in crypto. I'm saying this because he realizes that, look, there is a value to having these individuals, these professionals in my city, mainly because it's a property tax play, really. You get them to buy expensive houses, and then the money recycles into the system. If Philadelphia wants to do something where they're like, hey, listen, we want to really invest serious players, get investment money from serious players, get an office and whatnot, they need to work with those individuals as well. They can't always, the problem with Philly perception wise is Well, it's right near New York.
Right.
It kind of has that thing. So I think it's a little bit more of a PR thing. It's kind of set it apart.
We can keep talking about this. This can go on forever. This is an amazing conversation. So thank you, Falgun.
No
let me do a quick recap. So during this podcast, as we know, we actually discussed a variety of things. We talked about the fact that we talked about what the current environment looks like. We talked about just public investing. We then talked about private investing and what that looks like. We compared seed rounds. We talked about angel investing and your personal philosophy associated with that. We talked about Philadelphia as quote unquote Silicon Valley and if that's a real thing. And there are so many other topics that Falgun, you and I spoke about maybe getting into, but we just didn't get a chance to get into. So we'd love to have you back again for this. But what I do want to talk about is that nothing in this podcast was considered to be legal or financial advice. So it's purely for education and for entertainment. For those of you who missed it, where can they find you, Falgun?
Yeah, so I have a few places. I have my own website, falgunchakshi.com. So there's a lot of links to my social media outlets on there. I'm on Twitter at falgunchakshimd. If anybody's on Clubhouse, I'm there at falgunchakshi is my handle. I'm the only one there so far with that name. And then my podcast and newsletter, I have a newsletter on Substack by Looking Around the Corner, and it's the same name for the YouTube channel and on anchor.fm, which is what I use to distribute the podcast. So I'll be adding a few more episodes over the next few weeks as well. And yeah, please reach out. I'd love to network and talk to people.
Perfect. And if you like this podcast, please leave a message, leave a comment, subscribe. And you can find me on DarshanTalks on Twitter, or just go to our website at DarshanTalks.com. Thanks, everyone. Thanks for coming on. Thanks again, Falgun.
Yeah, of course. My pleasure. Thanks.
This is the DarshanTalks podcast. Regulatory Guy, Irregular Podcast with host Darshan Kulkarni. You can find the show on Twitter at DarshanTalks or the show's website at DarshanTalks.com.